Welcome to TradeWinx software. Maximizing profits strategically. 1. Analyze markets through fundamental analysis. In broad terms, fundamental analysis is the study of all the external factors that can change the price of an asset. It looks at geopolitical news like conflicts, elections, growth reports, employment, interest rate changes, etc. to then ride the market's movement and hopefully profit. It requires research, reading the news, studying world events, knowing the underlying trends in the markets you're trading, and the real situation on the ground as much as possible. For example, if you're trading on the release of employment data in Canada, you can't go off of predictions that it will, for instance, rise. You also need to look at the types of jobs that were added, how many hours workers put in, who's getting the jobs, etc. 2. Utilize technical analysis. Technical analysis involves using tools, typically graphical charts, to pull together statistics on A, trends such as new highs and lows for specific issues, stocks, commodities, or currencies, B, the speed at which an asset's price rises or falls, which represents momentum, C, the volume and number of both declining and rising issues, and D, whether an asset is trading either above or below average, which indicates volatility. Typically it involves looking at this all from a historical perspective to make predictions about future trends. Use these indicators for trends in high and lows, moving averages and parabolics R, stop and reverse. Examine the Relative Strength Index, RSI, the Commodity Channel Index, CCI, and stochastics oscillators to assess momentum. Study Bollinger Bands, standard deviations and the average true range indicator for insight on volatility. Analyze the on-balance volume, OBV, the Chaikin oscillator, and the rate of change volume, ROCV, indicator for market volume. 3. Examine market sentiment. Market sentiment is typically indicated by bullish behavior, such as buying call options and selling put options. It is also expressed by bearish behavior, such as buying put options or selling call options. Calculating the put-to-call ratio is a measure of market sentiment. To calculate this, divide the put volume by the call volume. When the ratio is low, you have a bearish market in which people are fearful. High ratios indicate the opposite. Your goal is to find the ratio that applies to the underlying asset you're considering trading on and use it to direct your answer to the proposition. 4. Sniff out fear. Because people pull out when they're nervous, markets drop faster than they rise. Exchanges recognize this and even publish volatility indexes that you can use to help in your decision-making. You can also actually trade binary volatility options on the Chicago Board Options Exchange Volatility Index, VIX. Give us a call +918 3910 94408. Register now www.stockbuysellsignal.com.